What's up, everybody? This is Sunko, the Korean bro. Today is 2022, December 2nd. And let's take a look at articles tonight. Okay. Hmm. Do NIO's record deliveries mean the EV maker has turned the corner? Top three tech stocks to buy during a recession. If you invested $5,000 in Wells Fargo in 2007, this is how much you would have today. Okay, three reasons Snowflake stands out to investors. Is Veru a buy? Tech sell-off, too nauseous. Stocks billionaires are buying hand over fist. Amazon just announced new innovations to take on Snowflake, Nvidia, and more. Two top growth stocks to buy during a once-in-a-decade opportunity. Okay. Do NIO's record deliveries mean the EV maker has turned the corner? NIO expects December deliveries to accelerate even further from November's record rate. The company's new sedans almost made up half of last month's deliveries. Shipments of the moderately priced ETF nearly tripled in its first 2 full months. New investors have been skeptical recently, but that may be about to change. Investors have been waiting for Chinese EV maker NIO to begin to show the promise many had already priced into the stock. That's been especially true recently as the company has had to navigate challenge after challenge. NIO needs production volume growth to accelerate. But headwinds this year have kept vehicle deliveries fairly steady, and losses continue to grow instead. With NIO just reporting a huge jump in November monthly deliveries on Thursday, investors might now think the company has finally turned the corner. Looking for a breakout quarter, okay? Just in time for investors, okay? It's been a tough year for NIO and other Chinese manufacturers. Restrictive COVID-19 policies have caused NIO's production to be suspended multiple times as well as impacting consumer demand. Several automakers, including Tesla and Mercedes-Benz, have lowered prices for the electric vehicles in China to help spur demand. With new models being introduced and expanding sales outside of China into Europe, many investors thought 2022 could be the year that NIO reached profitability. Instead, in the midst of the turbulent environment, NIO's losses have mounted. Many investors have lost confidence, sending the stock spiraling down about 60% year to date. Okay. Okay. Even with third quarter revenue jumping by 32.6% year over year to $1.8 billion. NIO. Okay. Reported net loss of about $580 million. That's up from $410 million in the second quarter and $280 million in the first quarter of 2022. But with fourth quarter deliveries now on track to become the most by a large amount, investors might have reason to feel optimistic. Smart settings to the rescue. NIO expanded its lineup to include smart sedan models this year after solely making SUVs previously. Sales of its luxury ET7 have grown, but investors have been looking toward the lower priced mid-size ET5 to have more mass appeal. The two models combined represented nearly half of November deliveries, even though the ET5 first shipped in late September. Sales of the ET5 nearly tripled in its first 2 full months of production. NIO hopes to tap into more of the consumer market with the starting price for an ET5 the equivalent of about $46,000. At the Chinese Auto Show earlier this year, NIO co-founder and president Qi Lihong said he expects the ET5 to gain more sales than the gasoline-powered BMW 3 Series in China within just a year. Pivot point for stock. NIO has now shipped more than 106,000 vehicles in 2022. Shareholders are hoping the November delivery report is a sign of things to come. The company also says it expects production and deliveries to accelerate further in December. To hit the lower end of its prior projections, the company will need to deliver nearly 19,000 units next month. That will be an increase of 32% from November's record. If that is accomplished, NIO shares could see a resurgence. Investors seem to already have been showing more optimism prior to today's delivery report. NIO shares have rebounded almost 25% in the last month from 2022 lows. Further strong increases in Xi months should drive even more of a recovery in the stock too. Three top tech stocks to buy during a recession. Viva dominates an evergreen in the shade of the CRM market. Fortinet is a leader in the recession-resistant cybersecurity market. Airbnb's business model is built to withstand economic downturns. Okay, Viva, Fortinet, and Airbnb. Over the past year, rising interest rates and the fears of global recession drove many investors away from higher growth tech stocks. However, dumping all of your tech stocks simply because a recession might be lurking around the corner doesn't make much sense, especially when some tech companies were built to withstand tough economic downturns. Viva Systems. Okay. Viva Systems is a top provider of cloud-based customer relationship management services for life science companies. Life science. It serves over 1,200 companies, including Pfizer, Johnson and Johnson, and Moderna, and it enables those clients to track their sales efforts, store and analyze their data, and track clinical trials and industry regulations. Viva's core customers are well insulated from a recession because economic downturns generally have a limited impact on most drug sales. Recessions might force drug makers to downsize their sales teams or postpone big R&D projects. But they will likely remain tethered to Viva's cloud-based services if they want to stay competitive in the saturated life sciences market. Viva's revenue rose 26% in fiscal 2022, which ended this January, as its adjusted EPS increased 27%. For fiscal 2023, analysts expect its revenue and adjusted EPS to grow 16% and 11% respectively, even as it grapples with lower R&D spending across the life sciences market. Viva's slowdown rattled some investors this year, but I believe it's still reasonably valued at 40 times forward earnings. This is a company that dominates a high growth niche of the CR market, still has plenty of pricing power, and will continue to profit from the long-term expansion and digitization of the life sciences market. So they got their own niche market, which is life science market, in terms of doing business in CRM industry. Okay. Fortinet is a cybersecurity leader that serves more than 500,000 customers worldwide, including most of the Fortune 500. 2 decades ago, it launched the next-gen firewall called FortiGate. That firewall became the heart of its security fabric, which now provides end-to-end protection services for on-premises, cloud-based, and Internet of Things devices. Cybersecurity companies are usually well insulated from recessions because most companies won't lower their digital defenses to save a few dollars. They might struggle to secure new deals throughout the downturn, but they should remain more resilient than last mission critical software companies. Fortinet's revenue and adjusted EPS increased 29% and 19% respectively in 2021 and 2022. Expect its revenue to rise to 32% to 33%, even after it's expanded its operations in Russia. And for its adjusted EPS to grow 42% to 44%. Unlike many other high-growth cybersecurity companies, Fortinet is firmly profitable by both GAAP and non-GAAP measures, which could make it an even more appealing investment as internet rates continue to rise. Interest rates continue to rise. Its forward price earnings ratio of 38 also looks very reasonable relative to its near-term growth. Airbnb is what I covered last time, so I'm just gonna skip this one. Wells Fargo, Snowflake, and 3 reasons Snowflake stands out to investors. Okay, Snowflake. Okay. Snowflake's fiscal third quarter revenue growth was significantly higher than expected. The company boasts billions of dollars of cash on its balance sheet and no debt. While some tech companies are laying off employees, Snowflake is aggressively hiring. This isn't your average growth stock. Data cloud platform company Snowflake impressed investors with its fiscal third quarter earnings report this week. Shares of the growth stock managed to rise nearly 8% by the time the market closed Thursday, the first trading day following the company's earnings report, making the move even more impressive. It occurred on a day the S&P 500 declined slightly. Here's a close look at some of the reasons why the company continues to stand out to investors following the earnings report. Rapid growth, tons of cash, no layoffs, okay? First and foremost, there's Snowflake's rapid growth. After guiding for its product revenue to grow 60% to 62% year over year, the company actually grew product revenue 67% to $523 million. Total revenue was $557 million, also increasing 67% year over year. Data is becoming deeply ingrained in how global enterprises think. Act, decide, and strategize, said Snowflake CEO Frank Slootman in the company's fiscal third quarter earnings call when discussing the company's momentum. Snowflake's data cloud strongly resonate. in large enterprises and institutions, he added. Yes, indeed, that's true. Data is becoming deeply ingrained in how global enterprises think, act, decide, and strategize. Yes, that's right. Tons of cash. Another strength of the company is its balance sheet. Snowflake ended the third quarter with $4.9 billion in cash, cash equivalents, and short term and long term investments. Even more, the tech giant carries no debt. Hmm. Going forward, this cash position is likely to remain robust as Snowflake operates its business with positive cash flow. The company generated $65 million of free cash flow. The cash flow after regular operations and capital expenditures are taken care of. In one more important point, the company has been able to continue hiring, while many other tech companies have had to either pause hiring or lay off employees. The tech industry shed nearly 10,000 jobs in October, uh, according to a consulting firm Challenger Gray and Christmas, and that number may have increased in November. But Snowflake has been taking advantage of this. Year to date, we've added over 1,500 net new employees, said Snowflake Chief Financial Officer Mike Scarpel in the company's fiscal third quarter earnings call this week. We view the current hiring market as favorable for Snowflake and will continue to focus hiring in product, engineering, and sales. Looking forward, Snowflake expects to slow hiring. It anticipates adding 1,000 net new employees in fiscal 2024, but this isn't a bad thing, indeed. It's one of the company's first major demonstrations of scale since its initial public offering. Okay. Uh, he mentions three reasons why investors need to focus on Snowflake, and those three reasons are no layoffs, rapid growth, and no debt. Mm. No debt, rapid growth, and no layoffs. Um, okay. Let's look at profile of this company once again to see what they really offer. Mm. 4,991 employees are working in this company. And what they do is they provide a cloud based data platform in the United States. Internationally, the company's platform offers Data Cloud, which enables customers to consolidate data into a single source of truth uh, to draft meaningful business insights, build data driven applications, and share data. Its platform is used by various organizations of sizes in range of industries. The company was formerly known as Snowflake Computing and changed its name to Snowflake Inc. in April 2019. Mm. So mainly what they do is they provide cloud, data cloud, where people can store their data, and it's not only for storing data. They can actually use that data and get some insights from the data and use it for a practical purpose. Uh, let's go to this website and see the details, right? Join us for a data leadership webinar series, weekly demo, hand-on jobs, office hours. One platform that powers the data cloud. Execute your most critical workloads on top of Snowflake's multi-cluster shared data architectures in a fully managed platform that capitalize on the near infinite resources of the cloud. Okay, that's about it. tech sell-off, two Nasdaq stocks billionaires are buying hand over fist. George Soros made a massive bet on Alphabet, increasing his stake by 1,086%. Ken Griffin Martin tripled his fund stake in the trade desk. Okay. So Snowflake. First, we have Snowflake. Right, Snowflake. And as the market cratered, wealthy hedge fund managers have been buying stocks that present as opportunities. Okay. From what I heard from famous YouTuber, I wouldn't call his name, but like he also said, there's certain moment where he buys a stock, and that's when hedge fund managers buy a lot of stocks suddenly, and especially when people are fear of downward trend, and when there's a moment people face fear, they just run away, and they just run away from stock market, and they would just avoid, right? And at some point, hedge fund managers buy a bunch of stocks, and that's the moment where that shows a signal. Mm. And not all investors are hungry now. Several well-known hedge fund managers have been buying stocks hand over fist as the downturn markets the best buying opportunity in more than a decade. Let's take a look at two stocks that these billionaires view as compelling opportunities right now. I'd like to buy a Volvo. Billionaire philanthropist and hedge fund manager George Soros was already a big fan of Alphabet. His investment fund, Soros Fund Management, held more than 53,000 shares of the Google parent as of July 31st. Fast forward 3 months, and Soros had gone all in, increasing his stake by more than 1,800%, increasing his count of Alphabet shares to more than 1 million. It's easy to understand why Soros will be buying shares of the tech giant hand over fist. Google's search dominance is unparalleled, controlling more than 92% of the worldwide search market. Add to that the reach of its streaming platform, YouTube, which attracts more than 2.6 billion visitors each month, and you have an audience without equal, feeding Alphabet's industry-leading digital advertising business, which accounted for roughly 29% of the global online and market in 2021. Let's not forget Google Cloud, the third largest and fastest growing provider of cloud service behind just Amazon Web Services and Microsoft Azure. The latest data shows that in the third quarter, Google Cloud's growth rate accelerated to 48%, easily outpacing AWS and Azure, which grew 27%, 35% respectively. Advertisers have reigned in spanning the face of a potential recession, which caused Alphabet's growth to slow to crawl, up 11% year over year in constant currency, down from its prior year growth of 39%. This too shall pass, as the old saying goes, and when it does, Alphabet's growth will surge. If there was a single reason that Roche went hog while buying Alphabet, it has to be the valuation. The stock currently trades for less than 18 times for earnings. It's the cheapest price earnings ratio since late 2013. As I look at it, its price level is 100. But people here, not people, like author of this article says it's still cheap considering the price level in 2013. Mm. And what we have next is a major league trade desk. In the third quarter, Ken Griffin, CEO and founder of Citadel Investment Group, was buying programmatic advertiser, the Trade Desk, hand over fist. Okay. The billionaire investor added more than 980,000 shares, an increase of 4%. This brought the hedge funds purchase 1.46 million shares worth more than $71 million. It gets better. The ad tech leader created a unified ID 2.0, the heir apparent to ad tracking cookies, which has been adopted by the world's biggest ad agencies and industry heavyweights. The trade has also debuted OpenPath, a mechanism that gives advertisers direct access to ad inventory, thereby bypassing the intermediary and saving money for its customers. Perhaps most impressively, the trade desk was able to buck the industry trend of diving growth rates. In the third quarter, revenue grew 31% year over year, down from 39% growth in the prior quarter. A far cry from the single digit growth of some of its rivals. Hmm. Okay. Trade Desk and Alphabet. Let's go to next one. Amazon just announced new innovations to take on Snowflake, Nvidia, and more. Amazon in-house chips and software offerings are becoming more advanced. Okay. Wait, hold on. They could potentially take market share from other big tech behemoths, attract more customers to AWS. Hmm. AWS continues to push the envelope to vertically integrate, challenging other top software and hardware suppliers. Probably Amazon has got plan to take on other competitors. Mm. They have their own chips and software, and it's more advanced than before. Apparently, uh, new in-house chips to power high-performance computing. One of the ways in which Amazon can lower costs for customers is by having them run workloads on its in-house processors. Amazon bought Annapurna Labs in 2015 in order to develop its own ARM-based semiconductor designs, and AWS has been building its chip capabilities ever since. So Amazon, if Amazon it makes products in-house, then they can offer product with cheap price, right? At first, Amazon used in-house processors to execute a simple task at low cost. However, in recent years, Amazon's in-house processors have become more advanced. Okay, in-house processors have become more advanced. Okay. Make no mistake, the current chip leaders are very advanced as well, with tremendous research budget at their disposal, and should retain their leadership status for the highest performance workloads. However, if high performance computing becomes more commoditized as time goes on, it's possible Amazon may be able to still market share in highly advanced computing applications. Hmm. Okay. Uh, so Snowflake. I just talked about Snowflake and its growth potential. They got no debt. They got rapid growth. Um, no debt and no layoffs. But obviously, in this article, it says that not Google, Amazon is now trying to come out with new innovation that could possibly take on, Nvidia and other companies, right? Mm. Vertical integration. Let's read articles about macroeconomic condition. Let's read a few of them and then let's get it over with today because I feel a bit tired. And tonight we have a big game, Korea versus what was it? I forgot the name of the country. Anyway, it was a big game. Okay. Let's see. Mm. Billionaire Steve Cohen goes big on these two high-yield dividend stocks. EOG Resources, uh, Healthcare Reality Trust. Okay, macroeconomic condition. November jobs report: payrolls rise by 263,000. Unemployment rate holds at 3.7%. Okay. Job growth slightly abated in November alongside rising rates, but reflected a stronger than expected hiring momentum, even as worries of recession grow. Hmm. Employment numbers have moderated in recent months, but employers continue to hire at a robust pace, even as the Federal Reserve presses on with its most aggressive monetary tightening campaign in decades to loosen an extraordinarily tight labor market that has placed upward pressure on wages and contributed to stubborn inflation. Okay. Hmm. Why the jobs report still matters to investors? Morning Bluff. Um, and though monthly inflation numbers have taken the title as the most important piece of economic data for investors over the last year, the jobs report should not be overlooked. Okay, so inflation report is the most important number um, that tells investors what to do, but it's not the only important aspect. What we have to focus on is as employment. Employment. That's largely because, in the view of Federal Reserve, Federal Reserve Chair Jerome Powell, recent jobs reports have been just too darn good. In a speech earlier this week, Powell said the labor market shows only tentative signs of rebalancing. Wage growth remains well above levels that would be consistent with 2% inflation over time. Although job vacancies have moved below their highs and the pace of jobs gains has slowed from earlier this year, the labor market continues to be out of balance, with the demand substantially exceeding the supply of available workers. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Okay. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. U.S. stocks sank Friday morning after stronger than expected jobs data had investors recalibrate expectations around when the Federal Reserve will pause its rate hiking campaign. Another strong jobs report and high wage growth confirms that the Fed job isn't complete yet. So basically, what they talk like overall, along with the trend of stock, they all say that rebalancing is not done yet. It's still in process, and like the Fed job isn't complete yet. Strong jobs report and high wage growth, like respectively, it all confirms that the Fed job isn't complete yet. So, okay, this is it for today. I did it really briefly, okay? And see you tomorrow or the day after tomorrow, okay? Bye bye.